All right. Well, I'd like to welcome Alec Gilliam, absolute brilliant part of our team. Been with us almost 10 years now and just has continued to build some amazing capabilities and skill sets for our team and for our clients, but also in the network that he lives in as well, with a lot of tech entrepreneurs and also others that have started their own businesses, several of which have come through Y Combinator and other great platforms on the accelerator side, others that have built some great businesses, a few that have already had their first or second exits already, and then some that even have a multinational presence. So when we were talking about some of the key themes around some of the blind spots for founders when they're first getting started, we wanted to really tap into Alec's expertise and what he's seeing in his network and some of the things that they run into. So first of all, Alec, welcome, and I look forward to
Thank you.
having you share more of your insights with our watchers. So with that, I know one of the key themes we've been looking at is what are the blind spots that happen with founders, and especially younger founders as they're starting to get their first or second attempt at the businesses, because many times they may be serial entrepreneurs or even parallel entrepreneurs.
Mhm.
As you look at that, what are some of the things you see that may be blind spots for some of the entrepreneurs and say the personal planning side of things?
Yeah, on the personal planning side, I think that's a pretty major blind spot for most first time founders and founders that have done it more than once. They often neglect the personal planning side of things. They know a lot about what their company burn rate is and how much runway they have until they need to fundraise again. But they don't often have that same knowledge for their personal runway and the financial situation going on the personal side. So when you're on a plane, you'll often hear the speakers at the beginning. They say, if there's turbulence, the mask will fall from the ceiling, and please put your own oxygen mask on before assisting others. Founders oftentimes do not do that in their company. So the stress and financial anxiety that can come from not doing your personal planning could lead to you as a founder doing work poorly or making bad business decisions or over raising or forcing yourself to not pivot and pursue immediate revenue over long-term growth. So could cause a lot of unfortunate things to happen. So it's good to pay yourself and have a plan to make sure that you're on the personal side taken care of. And then on the flip side, other things can happen. Some founders have what I would call an equity illusion. So they raise money, let's say at a $16 million valuation, and all of a sudden they think in their head, if they got 80% of the company, they think that they're worth 80% of 16 million, which it's not always the case because that net worth, that back of napkin math doesn't hold up when you're trying to adjust your lifestyle. So some founders will maybe take too much out of the company and use the company's bank account to enhance their lifestyle. And then if something disastrous happens, then all of a sudden that valuation cuts in half and their net worth cuts by this proportional amount, then they don't have the ability to sustain that lifestyle. And that can also lead to problems. And the third thing I would say there on the personal planning side of things is, once again, when their net worth is so concentrated into one asset, they have extreme concentration risk. So their venture capital firm that funded them has a bet on them, and so they have some risk as well. But they also have a bet on tens of others of entrepreneurs in that same batch. So as a founder, you are the least diversified person because you have most of your net worth, especially if you're a first-time founder, in just your company equity. And so if 80% of your net worth is in your company stock and it drops 50%, then you just lost 40% of your total wealth.
Great insights. And I think as well, that's one of the things we also see as those investors are looking to invest in the businesses. They actually view it as they want to see that there is some level of personal stability and not that the individual's pouring everything back into the business, because if they're that close and hanging by
Absolutely.
a thread, yeah, then they may be jeopardizing their investment in the business as an outsider if they are saying, hey, I'm 3 months away from being out of money myself personally, and so will they be able to continue with the business?
Exactly, because a founder has the extreme concentration risk in his company, but the company itself also has a major concentration risk too, and that's in the founder. The founder, they are concentrated in him and his ability. So investors do look at that to make sure, like, how's this founder's financial situation personally?
Fantastic. No, great insights there. Well, in regard to that, some of those things around the transition planning, we talk all the time about there's a lot of ways to enter a business, there's a lot of ways to exit a business. And as you think about that type of transition planning, what are some of the things that you see that founders may be overlooking or may need to pay more attention to?
Yeah, so in regards to transition planning, like I just mentioned, the business itself is heavily dependent on the founder. So most startups do fail because of market conditions, competition, lack of product market fit, those types of scenarios. But there also are a large portion of startups that fail because co-founders split up, somebody gets sick, somebody's personal life just walks right onto the cap table. So there's a lot of different transition events that can happen that might be planned or unplanned that can derail the company trajectory.
You're absolutely right there. And we talk about that frequently as well. You talked about sort of the personal life walking onto the balance sheet. That's a good way of phrasing it because
Yeah,
as we see, if someone's going through, say, a divorce or a contentious transition,
exactly.
folks are going to fight over the house and the curtains and the vehicles. They're going to fight over the business. And that's one that can take down the entire ship. So,
Yeah, and most co-founders don't want to be in business with their other co-founder's ex-spouse. That's not typically a wanted scenario.
exactly. Yeah, not necessarily a good alignment of interest and vision for the business there. It's just,
Right.
yeah. Well, in regard to that, tell me a little bit more about some of the things that you've seen in regard to, say, an event of death and disability or health events. I know we've seen some examples where there was one doctor that we were doing some work with, had some amazing cancer research that he was doing, and went out and ran a charitable 10K and didn't come home. And the business was dead 2 months later. There were a lot of folks who had lost their investment capabilities in that business. What do you see there as the opportunity for the death and the disability side of planning?
So, in regard to some of the unplanned transitions that can happen to a company, like death, disability, we find that most founders don't have a will, don't have powers of attorney, or any other estate documents that prepare the business for any of those events happening. And the reason that's a problem is because founders can't answer the question, if you were, God forbid, hit by a bus tomorrow, who signs payroll? Who controls your shares? Who makes the business decisions? And how does the business trajectory keep moving forward? And a lot of these scenarios can just be solved with simple insurance policies. So the purpose of the insurance policy, you typically think of providing for someone's family, and a lot of people do have that in place. But what a lot of people don't have in place is a life insurance policy, for example, that will provide for the business so that the business can transition effectively if, God forbid, something happens to the founder. So that basically buys time for the board and the team to make good business decisions and transition it smoothly while they're under a stressful readjustment period.